The primary purpose of this podcast is to educate and inform. The views, information, or opinions expressed by hosts or guests are their own. Neither the show nor any of its content should be construed as investment advice or as a recommendation to buy or sell any particular security. Security-specific information shared on this podcast should not be relied upon as a basis for your own investment decisions. Be sure to do your own research. The podcast hosts and participants may have a position in the securities mentioned personally through sub-accounts and/or through separate funds and may change their holdings at any time.
Welcome, everybody, to a new episode of This Week in Intelligent Investing. So great to have you with us again, and great to welcome my co-host, Elliot Turner, as well as a very special guest today, Bill Chen. Elliot will introduce Bill in just a moment, but suffice it to say, I'm extremely excited about today's episode. I think it's going to be a terrific one. In fact, we're going to follow it up with at least one more, or maybe even more than that, because we're going to be covering real estate, and there's a lot to talk about, and no one better than Bill to actually be a part of this conversation. So, Elliot, over to you.
Yeah, thank you so much, John. And I'd be remiss not to point out that we've had some episodes covering real estate, and I think it's come from, in some ways an outsider's perspective, but with a financial mind, thinking about real estate. Bill is someone who really knows the space, and he's been pounding the table on the opportunity today in publicly listed real estate. And we thought it would be an amazing opportunity to have someone who's an expert in the space share his wisdom with us on the podcast. We get to ask our questions, learn some for ourselves, and you all get to be flies on the wall listening to the conversation. So Bill is the founder and managing partner of Rhizome Partners. He was a real estate banker at Citigroup in the depth of the financial crisis. So he's got the nitty-gritty experience in some of the most important areas of the space. And beyond that, he has a degree in mechanical and aerospace engineering. So he worked as an HVAC engineer for a year in practice too. So he's seen blueprints, seen behind the walls in ways that help in real estate investing. He's also an all-around interesting guy, a great person. We first met through MOI, but got to spend some time together over the past few years. And I'm super excited to have Bill on here with us today to share his wisdom. So Bill, thank you so much for joining us today. Really looking forward to talking about the opportunity in publicly listed real estate. And maybe, to start, why don't you share with us a little bit of what got you interested in real estate investing in the first place?
Well, John and Elliot, thank you for those wonderful and kind words, and the bio. You're too kind, and I just want to say, been a big fan of the podcast. Learned a ton from it in the past few years. I was a very avid, listener, and frankly was, kind of sad to experience the low, but really glad that I could come on as a guest and contribute to the conversation. So I just want to emphasize that I'm a big fan. Learn a ton from all the conversation that the three of you had over the years. Now, as to my experience in real estate, if we have to go back to the early to mid 90s when I really got involved with it. I would say my first foray into real estate, a little bit background about myself, my family. I came to the States when I was 10 years old, and we were in the Chinese takeout business. So my parents don't speak English, which meant that I had to translate at a very, very young age and essentially become a bookkeeper for them. And probably in 1993, 1994, which is about 30 years ago, being kind of 12, 13 years old, I was already helping them make mortgage payments. And I remember having a 8.75% mortgage where the monthly payment on a 50-year amortization mortgage was exactly $1,800, right? I remember these numbers because I used to write out the checks. Believe it or not, I was also the one who was making the rent payments for our restaurant. And every couple of years, I have to kind of go talk to the landlord. Either something was broken, maybe want to fix something. And, I remember doing a very contentious, drawn out lease negotiation with them as a 12, 13-year-old. So the experience really goes back to my early teens when, I was just trying to learn English, and I was kind of thrown into this position where I really got to help out my family. So the next time when I really got to get some exposure was in the late 90s. Some of my relatives started buying up real estate in Brooklyn and Queens. And this is back when you could buy a building, like a 3-unit rental in Queens and Brooklyn for probably $300,000. Those are all worth $2-3 million today. So remember, some of my relatives started investing in it, and I remember there was a fire, and I remember chasing after the insurance company, helping them chase after the insurance company for like a $40,000 payout to fix the damages. And where I really my family really got involved was in the probably 2001, 2002. We probably made the most important bet in my family's history, which is we took out a home equity loan and we use it as a down payment to buy a pre-construction. And I'll go into some of the details. So it was a pre-construction project. We took out a home equity loan. It took 2-3 years for the building to be built. And that was a $600,000 purchase. We went in 50-50 with my aunt. And we didn't have the equity check. So we took out a home equity loan. By that point, that 8.75 mortgage, with 10 years in, we paid down a lot of principal, so we built up some equity in it. It was probably the riskiest thing that we've done as a family. But it was also the most important capital allocation decision that we made, because that wound up being a 10-bagger in equity return in over the course of 15 years. And that really changed the trajectory of my family's real estate portfolio and wealth creation, wealth building. Since then, we've kind of probably every couple years, somebody in the family would buy, a small 1 to 3 unit residential building in Queens. And we've kind of since aggregated to probably 40-50 units in total. So I've always had some sort of experience leasing units, fixing something that's broken, helping them source deals, helping them underwrite deals, and just giving them feedback on, hey, the subway runs through here, this is a great location, et cetera. And to be honest, I don't think we really knew what we were doing. There's a lot of luck involved in all this. There's this huge tailwind in New York City. So we got really lucky with both, what happened with New York City and also what happened with interest rates and in general what happened to rent growth in the past 2 decades. So, that was probably early 2000s when we started acquiring real estate in Queens. And then after that, I graduated from college. I worked as an HVAC engineer kind of around that, 05, 06 period. And I was helping laying out fire protection, plumbing, HVAC systems. And I was looking at the blueprint. I saw, all different building types. And I develop a innate feel for what the inside of building should look like. It's one of those occupational hazards. I'll walk into a building, I'm like, oh, that's a pipe, that's a RPZ, that's a backflow preventer, and blah blah blah. I could really nerd out on this stuff sometimes. And I would say what is most relevant to my real estate experience was in late 06, at the peak of the subprime mortgage, frenzy. I went to work for Citigroup in their real estate investment banking group, where we were really kind of helping wealthy family, sell real estate up to $1 billion. So I was in that kind of high net worth family office. That's who we were servicing. And I had some particular experience where we were taking a portfolio of regional malls to the market. We tried to sell a hotel. We tried to sell a bunch of projects. At one point, we were asked to sell the ground lease under Rockefeller Center. That was something where we had a conversation about. And so that was a particularly interesting experience because I went in when real estate was as liquid as cash. Like you just put an asset up and it got sold within days or weeks. And I saw the transformation from real estate as this like liquid, tons of liquidity for assets to you couldn't move it. And there was this like toxic connotation associated with real estate. It's kind of like, like people may not realize, but there was a time where homes are kind of considered like a toxic asset, right? Like we're in a very different environment today, where there's a huge shortage of single family homes, but like you almost couldn't give any of them away in '09. So that's a long way to describe like all the different ways that real estate have, I've come into contact with real estate and I've been involved in it one way or another. It really does go back 20, 30 years.
So you run a, public equities fund, and real estate is very much associated with and thought of as this kind of like, a liquid private asset, despite that little period where it's super liquid. Um, how do you think of real estate as a public security? I know you've gotten this question before, but are REITs actually real estate? Do you think of it the same way?
I would say that it's funny you asked that because I literally have real estate GPs tell me that REITs are not real estate, and I thought long and hard about it. I think that REITs are probably 80, 90%, they do give you real estate exposure. I think that there are, a lot of pros and some cons that you get from getting exposure to real estate via REITs. Here's a prime example. And I chuckle at this a little bit because there's this notion, like a lot of times real estate is pitched as this like passive income vehicle. But if you talk to any real estate owner or GP, they all have some sort of horror story, right? Either it's a nor'easter comes through and your tenant calls you, there's like, a foot of snow on the ground, and they're like, my heat's not working, like you got to come here and like fix it. That's happened to me before. And then you go there, you try to fix it, and you realize some pigeon that got carbon monoxide poisoning fell down, and you're like, it's like midnight, and it's 20 degrees outside, and you're trying to like get this boiler to work so that your tenant won't freeze, right? So real estate is definitely not passive. If you own it, there's definitely a very active element to it. And that responsibility of dealing with whether it's a broken toilet, whether it's a boiler that needs to be fixed in a snowstorm, some sort of HVAC, or just, the buildings get old and needs to be renovated, someone has to handle that, right? If you own it yourself, you are responsible for managing that asset and dealing with any troubles that arise. So REITs, or you could outsource it. You could hire a property manager to do that for you. But, my point is, if you own it through a REIT, you don't have to deal with that. There's a professional management team, there's an executive team, and then there are people at the property level who do take care of all those issues for you. So from that perspective, REITs are a great way to get real estate exposure without all the active headaches that comes with it. It truly is this passive form of real estate ownership. Now, I think that there's a lot of other elements, right, like of real estate ownership. Let's kind of talk about liquidity, right? I mean, real estate is generally known as a very illiquid asset class. And this is probably one of the most fascinating aspects of owning REITs and real estate C Corps in the public market, because you're taking a asset class that is known for being owned by families for generations and passed down for generations. There's a lot of families in New York City that has owned office buildings and apartments from their grandparents or great grandparents, and passed down through the generation in the family. And yet you somehow fractionalize that asset and you make it instantaneously liquid. And in that process, some like weird dynamic happens. Like people start treating REITs as if it's a bunch of paper, it's just a security. But if you really think through, for example, we own just under 2% of a publicly traded company. And I spend a lot of time thinking about, okay, well, that's, 20 units in Washington, D.C. That's, they happen to also own some aggregate assets. And we literally own, indirectly through the stock, 11 million tons of aggregate reserves, right? Literally like rocks and sand in the ground. So we take a very private mindset to public ownership. I know sometimes like people kind of, make fun of that kind of statement, but I kind of live and die by it, right? Because when we put on a position, I really do sit down to think about, well, if we got this, $5 or $10 million position in a company, how many apartment units is that? What is the dollar per door that we're buying it at? And what is the fair market value? So you could kind of choose, you have a choice. And this is what Buffett is so good at. I think, Buffett uses the Mr. Markets example of saying, you could choose to just treat it as a piece of paper, or you could choose to view it as, hey, indirectly by owning these shares, at X million dollars, like I actually own this many units where I am entitled to this amount of cash flow, and they are paying me this much in dividends per year as a shareholder, as an owner of these assets. So in that perspective, it is absolutely a real estate, right? REITs are absolutely real estate because you are enjoying that cash flow. You are participating in the long-term ability of that asset base to grow its rent over time, to participate in the in either the appreciation or depreciation of that location, to participate in the appreciation, depreciation, of the specific asset class and all the dynamics with associated with whether it's residential, warehouses, or offices, right? So from that perspective, absolutely. I have other topics. Like, I don't know if you guys want to we can take a little break and I keep going.
Well, yeah, no, let's keep kind of exploring
Yeah.
this territory, I guess. One of the things you mentioned, like C Corps also, but do you have a preference when you're looking at a list of companies, like trying to think about where you want to invest in real estate publicly, if a company is organized as a REIT or a C Corp?
So I think the biggest factor is probably valuation. So like I would say valuation and management quality are probably tied at the neck, in terms of significance. If I can find something that's deeply discounted and there's a solid management team, I don't really mind whether it's a REIT or a C Corp. Although if it's a dividend paying REIT, obviously there's advantages because I'm putting dollars in my pocket today. And if it continues to stay cheap, it provides me the optionality of creating my own share buyback, even though it's not the most tax efficient form, but it gives me the optionality of being able to acquire more shares with the dividend that I receive.
And then, when you talk about cheapness, right? Every REIT will tell you, and I feel like this was the case for the whole time during ZERP, and it remains the case that, hey, look, we're at a discount to our NAV. Like this discount is chronic, and it, no matter where the stock is, they always seem to be talking about their discount to NAV. How much faith do you place in the NAV that REITs or even C corps will tell you their worth, and what sort of like adjustments might you make to it, and what are your key factors that you look for to identify like true cheapness?
That's such a good question. That's such a good question. And it's what I do is I I do a probability weighting. What I tend to find that the public markets really punishes anything that has a terminal risk element to it. Perfect example would be office at the moment. If any asset class is perceived to have some sort of terminal risk, the public markets tend to not give it, a decent multiple. This kind of applies to non-real estate assets as well, right? And this happened to retail. Before this, before office becoming the problem child of the real estate industry, retail and the rise of Amazon e-commerce was kind of viewed as this apocalypse for retail, and people lumped grocery anchor retail, strip malls, along with the indoor malls. Everything was kind of lumped together, and a lot of these retail REITs just couldn't really get a bid, right? So I think anything that has a perceived terminal risk, until the market starts believing otherwise, it tends to be difficult for them to re-rate to what a true NAV is, unless there's some sort of liquidation process going on. There's a couple, office liquidation that's going on right now. So that's a form where they're being marketed, they're being sold in a orderly process. So you could actually close that gap. But what I've also find is, and this took me 5-10 years to kind of really figure this out, is that REITs, like other asset classes, kind of go through periods where one asset class is favorable and another asset class may not be, maybe out of favor. And there's a dynamic of like, is it working? Is it like a great contrast is when COVID was breaking out, a lot of the coastal REITs were trading at big discounts. People didn't want that New York City, didn't want that coastal exposure. People were absolutely enamored with the Sunbelt, right? And then fast forward 2-3 years, they built a lot of supply in the Sunbelt, and that's all being delivered today. And everyone's freaking out about all this, this wave of supply. And the Sunbelt trade at much higher cap rates than the coastal. So, like what I try to do is, again, I keep thinking, I own these assets. Again, I keep focusing on, I own X number of units of apartments with my exposure. And I try to think, okay, in 2-3 years, people, the supply gets absorbed, and people will want to own these assets again, right? So I try to think 2-3 years out. I try not to get too caught up with like what's happening right at this moment. Now, there's other nuances like, what is the historical capital allocation decision making of the management team, and if they are, if they've done a good job allocating capital, then that is, the market will tend to reward management teams for doing so. I think some of the like complexity tends to be punished, right? I've come to appreciate bigger, more liquid, pure play REITs. None of what I'm saying is kind of some sort of trade secret. This is just from doing this for a decade that, a lot of times what I've learned the hard way is, I could buy like a smaller market cap, less liquid name that's cheaper on some of the parts basis that may have 100% upside. And then I could look at a large liquid REIT that may have 60% upside. I have learned that sometimes it's better to overweight the larger ones a little bit, because when the market sentiment changes, they want to get exposure to that asset class. For example, Sunbelt multifamily, the dollars will flow to the larger market cap, and those discounts will tend to close like faster and earlier. And then you may get a second bite on the, on the smaller market cap, less liquid, with a little bit of hair and complexity on it. Those are just from, personal observations from doing this for about a decade.
So when you do a valuation, right, or you talked about some of the parts or any kind of valuation, do you rip up company NAV and focus on like a property by property? Like, these are the comp multiples I can identify for this given property, and then build that all up?
Yeah, no, absolutely. We, to the extent that we could do the valuation on a individual asset level, we would try to do that. And a lot of times we would try to put boots on the ground. My analyst and I have put boots on the ground. We, one of the companies that we invested in earlier this year, we flew down to, we flew down to the city and spent like a week on the ground talking to leasing agents, and we'll go tour the apartment buildings and just try to form really strong opinions on and develop the conviction that the local market is what we think it is. The specific asset and their positioning in that market is what we think it is. And a lot of times, like, we'll go in with certain assumptions and probably going to be right on 6 or 7 out of 10 of our assumptions. And then there's like 2 or 3 of them where, they could be better. Like, the reality is actually better or worse. And we're, like, more often than not, we're very glad that we put boots on the ground. And we do build our internal NAV models. We don't rely on Green Street. We don't rely on any of the vendors. Like, we try to get the data from the filing, the supplementals. Like, one of the really nice things about REIT investing is that the companies give you a treasure trove. Like for people who are really into detail and asset by asset, they give you more information than any other asset class that I could think of. And if you are really enterprising, like, we've done like a 3-hour walk in Midtown, Vornado and SL Green. Like, we basically hit up probably all the buildings that account for 80% of the value, right? Like, we see it in person from outside and just go from one building to the next and kind of get a sense for the location, the traffic flow. Like, if you're an office user, would you want to be here? If you're a retailer, would you want to be in this location? We do a ton of that, and that's kind of what we pride ourselves on.
So, like, in that trove of information these companies give you, they'll always try to peg, and they'll tell you what they think NAV is. Do you think, are there any companies you'd point to as like beacons of integrity in terms of how they build up their NAV, and whether it's done in what you'd say is like a honest, fair way? Or like, are any companies do any companies fit that bill?
I would say, for the most part, from what we found, is that 80-90% of time, a lot of the NAVs that they create, that they present to you, are correct. Like, from our experience, that's like they're often they're correct more often than they're not. And I would probably peg that at 80-90%. Now, I think that sometimes the market will give a big discount to a particular company because either they're just their historical capital allocation has been very subpar. They're just abusive toward their shareholders, or they'll state that their objective is to do one thing and then they'll go do something else. So like in those scenarios, those NAV, they can kind of like tell you what a NAV is, and that NAV is just not correct, right? The other instances where the NAV deviates from, their stated NAV deviates from what like true value is when an industry is going through a rapid phase of kind of like intrinsic value reset. A good example would be office, right? I remember Vornado used to kind of give you some sort of guidelines for how to think about NAV. And then, of course, with like COVID and work from home, all of a sudden, like, this a 5% cap rate, paying a 5% cap rate for New York City office, just it kind of sounds outrageous, right? And you have to like rapidly change the cap rate assumption. So I don't think they were particularly looking to mislead investors, but it's just what happened to the industry. And keep in mind that within the real estate, within REITs and real estate asset classes, there are times where a asset class will go through a rapid phase of cap rate compression or expansion. We saw this with warehouses since like 2015 till probably 2021, where I remember underwriting a company and using an 8% cap rate assumption for warehouses. And you will get laughed at. Like that is such a absurdly good price for a warehouse. That was back in 2015. And a lot of times today, they probably got down to as low as 4% cap rate recently before the big interest rate increase. So you could have asset classes where if they're experiencing a ton of rent growth, and an asset class that goes from kind of being like a fringe asset class that's not really institutional quality to becoming kind of more of an institutional quality. It's more accepted by the big dollar allocators. You could see like very rapid cap rate compression, and sometimes what the company laid out as NAVs and their cap rate consumptions could kind of come across as being too conservative. So we've seen that. Now, in terms of like, I've seen companies. I've seen a few companies that are too conservative with a NAV estimate. I've seen, but in general, I say 80-90% of them, when they give you a NAV and a way to think about it, and this is more for like the bigger pure play REITs, right? Not some of the more hairier, complex, some of the part stories. I think once you go into some of the part story, like that's where I really gotta like come up with my own opinion of like what does some of the parts are worth.
So maybe talk about cap rates a little bit, because like when I talked through the financial crisis or through the ZERP period with other pure equity investors, so talking about like regular companies, not real estate. A lot of my peers would say stuff like, yeah, I use a 10% cost of capital because I'm expecting some degree of normalization. ZERP's not here forever. I don't want to be too dynamic with how I move my cost of capital based on the state of Fed policy or inflation or whatever else it may be. But in real estate, it seems like things definitely, they transact based on very different expectations on cap rates. And not to say that equities don't, right? Volatility is pretty damn high. But like, how do you think about cap rate? How do you come up with like what's appropriate? How do you think about an appropriate spread? Is a spread the right way to think about things versus treasuries or anything else for that matter? Like, talk me through your thinking on that.
Yeah. I mean, yeah. So like, give our listeners a little bit of background. Like, we do a lot of real estate investing, but the other half of our portfolio are kind of traditional value. So I definitely come from a world where I'm trying to buy companies trading at under 10 times free cash flow. It's very rare to be able to buy real estate assets at a 10% cap rate. I I thought a lot about this question, and I happen to come from both worlds, like the real estate side and the non-real estate side. And I think that you have to, this is my theory, this is Bill's theory, is that you should think about real estate from a spread perspective. And there are papers out there that kind of tracks the spread, we'll say like multifamily, right? Multifamily cap rate spread over a 10-year treasury yield. If I remember correctly, it's typically between 100 to 200 bips, right? So today, the 10-year US Treasury is about 4.3, and if you put 100 bips to it, it's 5.3 to 100 to 150. It's 5.3 to 5.8, right? And if you kind of look at what Blackstone paid recently for this Air Community deal, it's like there's like tax adjusted, non-tax adjusted. It is like squarely in that range. Like I've seen estimates from 5.3 cap rate to 5.9 cap rate, right? It's just like it's too much of a coincidence that that Blackstone, being the $1 trillion asset manager with the best information out there, generally considered the smartest real estate investors, they did a deal recently, paying between 5.3 to 5.9, depending on who you ask. So I think it begs the question is, well, I'm sure Blackstone knows how to deal with DCF, right? They're not going to use a call it like your 10%. And I think you have to look at a multifamily as you could invest in 10-year treasury at a 4.3, 4.4% yield today. And there's some trade-offs. The trade-offs are you get the credit quality, the credit backing of the US government and its ability to raise taxes. So you get certainty of there's no credit risk if you're American. You generally don't think of the US as going to default on its debt, right? But the downside is that you don't have any inflation protection. You buy $100 of US Treasury, you get 440 of interest income, and then in year 10 you get your $100 of principal back. There is no principal protection. Now, what's also interesting is that if you look at the yield on the tip on the 10-year, the last time I checked was about 2.1%. The yield's gone down a little bit, so maybe even below 2%. So generally, real estate such as self-storage, multifamily, shopping centers, I mean, over time, they tend to be able to raise rent and it's be able to, keep up or beat inflation. And the market rightfully, assigns it value in its ability to keep up with inflation over time. So I think the right way to think about it is that you could think of, okay, I could buy a multifamily building and I get a certain yield out of it. You got to also account for, maintenance capex and what it costs to keep it so that cash flow will stay there, but also grow and keep up with inflation over time. There's a certain cost to it, which is a whole separate conversation. But generally, as the rent grows in year 10, there's good chance that if you have the same exit cap rate or even slightly higher exit cap rate, your building is generally worth more in 5-10 years from now. So I think from that perspective, it makes total sense for a lot of the real estate to be valued. It's really like a bit of a hybrid bond, fixed income, and equity vehicle. And I think it should just trade, like a good way to think about it is just the cap rate should be some spread over 10-year yield.
So when you think about what Blackstone paid for Air Communities, I mean, it was less than that. Why do you think they were willing to pay so much or such a low cap rate, relatively speaking?
So, and to add a little bit of further detail, the vehicle that bought that deal targets kind of it's in the value add strategy, and they tend to target a 15-20% IRR,
And it's
or like
not B REIT,
50.
right?
Yeah, it's not. My understanding is not. It's not B REIT that bought it. It's one of their more opportunistic vehicle.
Isn't there
And
a cynical take that like maybe they did it to have a better comp multiple when they go and revalue B REIT to kind of take care of some of these redemptions?
Oh, Elliot, we could get into conspiracy theories about B REIT. Not
Yeah, just
conspiracy theory, but
throwing that one
Bethany
out there.
McCain. Yeah, Bethany McCain wrote that article recently. I mean, B REIT could probably be like a separate, a whole separate episode. But no, I mean, I think that now I'll say this. Personally, don't think that paying somewhere between a 5.3 to a 5.9 cap rate is my type of like pound the table, back the truck up type of investment. You know, we're very cheap, and we have a very high hurdle for capital, putting out capital. But I think that I've also have observed a lot of conversation with real estate GPs, and what isn't kind of talk about a lot is again going back to the ability to raise rent over time, and then you layer on some leverage. Let's say you borrow, somewhere in the five or even low six, right? Which like there isn't a ton of positive leverage there, but if you're able to lock that in for 5-10 years, you could usually like grow into it and get positive leverage like a little bit later down the road. They're also putting in $400 million to kind of fix up, do some value add, and perhaps there's some low hanging fruit there, some projects they could do where they could raise rent, even just by 200-300 bucks per door. That could go a long way to increasing that yield and bring it to the six range, right? So I think like if you do the math, and we've done a lot of this math, which is kind of a little bit hard to articulate on a podcast because it's like better to be presented like in a chart or like in an Excel file. We've done a lot of this math where even if you just have 2-3% rent growth in the next, say, call it 5 to 10 years, if you're able to put 50% loan to value on this collection of assets, and if you could kind of pick up another 50 basis points of yield by doing some value add projects like it's very common in the apartment business to put in a new kitchen, and they've been a lot of these investors have become, they've been able to like calculate that return on that renovation, and they know what kind of yield they're getting, what kind of uplift in rent they're getting. So I think that you could still get to, you could get to like a double digit, a teens IR on a $10 billion deal, and it's not, I think a lot of times um, when I talk to non-real estate investors, they're kind of shocked at, hey, it just seems like a very low yield. Like, how do you get to a double-digit return? And if you sit down and you do the math, you apply the leverage, you apply the cost of cap, the cost of that leverage, you adjust for the amount of leverage you put on a portfolio, and you just kind of put in very modest rent growth. The results are very often in double digit range.
So like you said something along the lines of an 80 LTV, but I don't see that many public REITs operating with that degree of leverage. Do you think that's one of the advantages that Blackstone has in being able to buy it in this opportunistic structure?
I want to give a little history lesson here. And on the public side, in general, if you wind up with, kind of like a upside down capital structure that's viewed as like, where your debt is a big part of the enterprise value, it's usually not by design. You usually kind of get there somehow. Like like most REITs, there's this kind of implicit understanding that if you're a large cap blue chip REIT, you keep your net debt to EBITDA below 6 times. For apartment REITs, like it's kind of like well known that is like the demarcation line between what is a conservative finance REIT and an overly levered REIT, and so. And a lot of that is a product of the GFC, and this is something where like I have to like kick and scream. People say, okay, well, REITs went down 70-80% in the GFC, and I'm like, well, have you looked at their leverage ratio since the GFC? Because net debt to EBITDA has come down a lot, and then due to the fact that net debt to EBITDA has come down a lot, and then the fact that there's, we were in the ZIRP world, so a lot of the debt are simply just a lot cheaper today. A lot of the large cap REITs like could cover, especially the apartments, they could cover their fixed charges between 6 to 8%, and these differ across different real estate sectors. I mean, Prologis is the biggest warehouse. I believe their coverage ratio is somewhere in the 9 times range, right? And this kind of like it creates this like Buffett image of a truck driving over a bridge. Like, this is literally a bridge that can handle like 9 times, right? 6 to 9 times the weight of the truck. A lot of times on the private side, at the time of loan origination, like the banks generally want you to be able to cover your fixed charge by 1.25 times. That's generally like a rule of thumb. They want you to be able to cover 125% versus 6 to 9 times. And yes, like that is, that very often is a source of why some of the privates outperform the public is due to the fact that they simply use more leverage. It's very uncommon for a private deal to use less than 50% loan to value. And I've seen leverage as high as 80%. Somewhere between 50 to 80 is kind of very common on the private side. But on the public side, a lot of times they're kind of, very often they're below 30-35%. And the ones that kind of go above 6 times net debt to EBITDA usually gets punished by the market, and they tend to trade at a lower valuation at a higher cap rate.
And they cut their dividend to pay back debt, right?
Cut dividend, sell non-core assets, sell non-cash producing assets where they may be very valuable, but they don't throw off any cash flow. And or they could even sell existing stabilized assets that tends to be able, you're generally able to deleverage by selling perfectly fine stabilized assets as well.
Why do you think more publicly traded REITs didn't go private during the ZIRP period and take on a whole lot of long-term debt? Because
during the ZIRP period, the public REITs, the ones that were rewarded by shareholders, had a decent, cost of capital advantage, in the sense that, one of the reasons why I am more vocal to kind of talk about REITs today is that they're so different from the ZIRP period. During the ZIRP period, REITs very often traded at a 4% cap rate, and so they lever it, keep the leverage at 6 times net debt to EBITDA or below, and they could issue equity to to do acquisitions. So they're different, right? They just play different games. On the private side, a lot of times, a lot of value comes from leveraging a portfolio with higher amount of leverage. But on the private side, they have access to very cheap financing, but by implicit shareholder agreements, they run it with very low leverage. And then when the management teams think that their stock are kind of overvalued, they'll issue equity to do acquisitions. There's a company, Rexford, which is concentrated in Southern California, and they own warehouses and industrial buildings. And they were literally sent out letters to owners that own industrial assets, saying we will buy your asset at essentially like a 3.5-4% cap rate, and here's an offer for $50-100 million to buy these assets from you because I've seen one of them. And they're able to do that because in the ZIRP period, they probably borrowing at 2-3%, and their stock was trading at a 3% cap rate. So they could, when they wanted to make that acquisition, they could just they could just get 10-year fixed rate debt at very low rates and also issue equity. So like if you think about going back to the fundamental question of like why be public, right? Why you're public to be able to use both equity and debt as a source of capital. And when the market likes your particular asset type and the exposure that you provide, they'll trade it to a premium to the private, and you could use it as a currency to buy private assets.
That Rexford example makes me think of the alchemy of REITs from George Soros. Have you heard of that specific essay that's featured in the Alchemy of Finance?
Yes, I definitely. I mean, I have not read that specific essay, but I live and die by reflexivity. Although I do have to say that we generally have not owned a lot of REITs that have been able to take advantage of its reflexivity, because then by definition, they're expensive.
Well, yeah, so that was Soros' point, right? As long as these REITs are trading at a fairly decent premium to book value, and he wrote this in 1970. I think that was like 1 year after REITs were created as a thing that you could publicly trade. He's like, as long as they're trading above, decently above their book value, the market's giving them an inducement to raise equity and purchase more real estate assets. And the more assets they purchase, the better their growth looks. The more book value goes up, the more they could raise more equity, and rinse, wash, repeat until, the growth kind of hits its natural stalling point and you just can't do it anymore. And everything collapses on itself. It's so interesting that he had that right away. But what you're talking about with Rexford, I mean, sounds like a way less extreme version of that.
Well, I could give you an extreme version.
Yeah, go. I love it.
So one of the extreme version was we've had warehouse exposure. We kind of like accidentally picked up warehouse exposure via one of our companies. I wasn't looking specifically for warehouse exposure. It was just that one of the companies that we invested in were very cheap on a sum of the parts basis, and about half of their asset was, like a 4 million square foot of warehouses, which was subsequently bought by Blackstone, and that was like a pretty good payday for us. But at like the same time, there's another company called Innovative Industrial Properties, which uses, they've been rolling up greenhouses for cannabis. And it's one of those things that that's not a company that I would have invested in. But what they've done, and the way that, if you talk about like public-private arbitrage and how to like play that to perfection, The stock was kind of like mid-teens in 2017 and reached a peak of 256 in 2021. And what they did was the market got excited about the row up of greenhouses, these cannabis growing facilities, and so the stock traded at a really good price, and then there was no financing. The banks didn't want to bank. The banks didn't want anything to do associated with cannabis, so they were able to buy up, these cannabis growing facilities at 12% cap rate, and through that reflexivity, there was a 15-20 bagger in that stock, and that was something that I kind of I looked at it and I kind of ignore it, but like to kind of see that, I mean, that's a perfect example of reflexivity in play. The ticker for that one is IIPR.
I find those situations tough as a value investor where you're like, this obviously is going to work and it's going to work for the dumbest reasons. And I just can't participate because I can't trust it. I can't trust it. I don't believe it, but it's mentally challenging. But that's a really interesting example, and it makes sense because there's such a finite number of ways that people could invest in publicly listed cannabis, and it was effectively giving the masses what they want, right? Kind of like what Roaring Kitty asked for before that was such a thing.
I'm doing some calculation. So innovative industrial properties, the current market cap is $3.2 billion. And they raised $1.9 billion through equity within the last 5-6 years. That is a company that played the game of reflexivity to perfection. And this is like
stock chart. That's wild too. It was as high as almost $300 a share, 114 as we're recording this.
Yeah, and this is like not an endorsement or we never own the stock, but it's I think when you talk about reflexivity, this is like the most prominent example that I could think of. That is like a perfect textbook example of like how do you exploit reflexivity.
So, changing gears a little bit, maybe in the closing minutes of this first episode covering the real estate space, talk through the various end markets and maybe help us understand like where you're seeing the most value and where you're thinking about, I got to stay away from this. The easiest questions, Yeah.
I mean, we love the large cap I think the publicly traded apartment REITs are super interesting. And give you a little bit of context. This is an asset class that I've been tracking for probably over a decade at this point, and I am friends with a lot of real estate GPs that I met through Twitter, and I follow a lot of various accounts. So I get real-time updates on, what deals are selling for, whether they could, greenlit a development. What I'm hearing is whatever deals that are being bought and sold right now are still in that 5% to 5.75% cap rate. And another thing we didn't talk about is a lot of times the public REITs, the asset quality owned by the public REITs tend to be a little bit better than the private REITs, than the private transactions. So you could still buy a lot of big blue chip public REITs in the Sunbelt, at between I haven't updated the valuation in a while, but probably at least in the 6.5% cap rate range. And this is for a big diversified portfolio with, lots of different exposure to different regional markets. So you don't have concentration risk, right? You don't have what Joe Greenblatt would call it sinkhole risk, where you own one asset and a tornado comes through and and totally destroys it, or there's literally a sinkhole and your building falls into it. You get exposure to a dozen markets. There's hundreds of buildings, and you could buy that with a click of a button in the public market at like probably a 6.5% cap rate or better today. Like I need to update my cap rates because these prices move around from day to day. But so I think the apartments are super interesting. For anyone listening, I share some analysis with John on MOI Global and the Best Ideas conference earlier this year. So I just want to give a shout out to that. There's some analysis there where listeners could kind of like see some of the analysis that we've done. So I think apartment REITs, particularly in the Sun Belt, are super interesting right now. They're trading. Another thing is you get the diversification, you get the liquidity, but you also get they have access to capital right now. Both Mid-America and Camden have been able to issue 10-year fixed rate debt on an unsecured level, meaning that they don't have to mortgage, they don't have to put like any sorts of mortgage on any of their properties, which they could reserve to do at a later time. So the capital markets is only charging them between like 4.9% to 5.3%, if I remember correctly. These are all very recent 2024 transactions. So you got this narrative out there that this coming wave of the biggest delivery of apartments in the Sun Belt, and then the capital markets are saying, "Oh, you wanna borrow $400 million? Okay, that will cost you between 4.9% and 5.3%. It's fixed, and you don't have to, give us any collateral on any of your assets. Like this is unsecured debt." So I've been pounding the table probably since the fall of 2023 that this is one of the best, most obvious, bargains in plain sight. And it's easy for me because I just kind of think about it. I'm like, if I got $1 million exposure, that is about 6 to 7 apartment units in the Sun Belt through one of my companies, and I'm just it's very easy. It is the easiest way to apply Buffett's Mr. Market example, right? Like think like owners, because this is a very easy asset class for me to act and behave that way. And I just sit there and think about that. I think that warehouses had a great rebound late last year, and it's given back a lot of those gains. So I find that a lot of warehouse REITs are also interesting. Prologis and Terreno. Some of the self-storage REITs are also interesting. We kind of like in later episodes and go into specific details. I think office, we're finding value in office as well. It's just that like you really just got to make sure you pay the right price for them. And I could talk about in a later episode, how kind of around the time that that CRE podcast dropped, we were actually underwriting Vornado, and we wind up owning some preferreds. So I could go into detail on like why I think it's actually a lot more. There's a lot more protection than what was discussed. We like grocery anchor shopping centers. I think that there's been a huge under construction of grocery anchor shopping centers. So there's a lot of categories. I mean, the one thing that I probably won't touch is still like the B and C malls. I mean, a lot of them have gone bankrupt, but like I just really don't think any of them really exist. I think there was probably a time when Simon was a really good value at $50 a share, but I think at today's valuation, I'm not a big fan of the indoor malls, but I understand that Simon's got a very different asset quality. I think that at the right price, owning the clear Class A office in a market is still worth it, still worth the risk. But I think you got to get a good price, and it clearly needs to be the Class A assets, like One Vanderbilt owned by SL Green, or some of the newly the Farley building owned by Vornado that's leased to Facebook. I think those assets have staying power that differentiated. They're different. And let me see what other asset types are there. I mean, it's kind of like a buffet right now, right? It's kind of a buffet right now for me. It's kind of like everything looks great. I mean, and I also wanted to highlight that I didn't feel this way for 10 years. I was very frustrated for 10 years because in the ZERP world, it was very, very difficult to find targets. And we were lucky if we find, more than 3 really attractive real estate names. And I could tell you that as we speak today, we could very easily build out a portfolio of 15, 20 names where I'm like, this looks great. This looks great. So it's a very exciting time for me. And I've been waiting around a decade for an opportunity set like this.
And that's why it was the perfect time to have you on the podcast. I think you teed up the opportunity set and our capacity to dive in much deeper into the specific areas for the next episode. So this was fantastic, Bill. Really appreciate you coming on, getting us started, understanding the space, some of the contours of what's good and bad to think about, how to frame analysis, and all the key variables. So looking forward to the next conversation where we get even deeper.
Yeah, I'm excited.
Terrific. Thank you so much, Bill. Thanks, Elliot. I'm going to have some questions next time, I promise. Really looking forward to it. Thank you.
Just don't make it too hard, guys, okay?
All right.
No more B-REIT fraud questions.
Take care for now, everybody.
Thank you for listening to This Week in Intelligent Investing, brought to you exclusively by MOI Global, the research-driven membership organization. Learn more at moiglobal.com.